So remember, we've been talking about key roles, key policies that senior executive will have to take, especially senior financial executive or a financial advisor. And we said you have to be able to make good financing decision. You need to make good investment decision, dividend policies, risk management, strategy, financial planning, communicating those planning to the key stakeholders, and likewise being able to monitor and control as you deem appropriate. So I've been trying to do some revisions for you on investment decision, which we have summarized earlier on, using NPV to make decisions. And I told you, core of those discussions will come in the subsequent syllabus. Yeah, on financing decision, we said there are two key areas we'll be looking at, which is deciding whether to finance using equity or to use debt. And I did a quick review for you on different types of how you can issue equity as a form of financing and the methods that are not necessarily going to provide financing for you. Now, I want to look at debt financing, and here I'm going to be starting with what is debt. Debt is other people's money. That is just it. When you are borrowing money from someone to be repaid back, you have an obligation to pay back. And there are different types of bonds that can be issued, different types of debt. The very common and easy one you probably have heard of is the zero coupon bond. Yeah, zero coupon bond. Yeah, what does this mean? This is a bond without interest. Yeah, zero interest. And if there's no interest, then you need to find a way to compensate the buyers, the investors. And how do you compensate them? So usually this is always sold at a deep discount. So which means usually it will be sold less than $100. Remember, every bond has a par value of $100. Yeah. And mostly when these bonds are sold at zero coupon bond, they have to be sold at less, so maybe like $65. So that by the time the guy redeems at $100, at least he's able to make like $35 profit at the minimum, on the face value, just like that. So that's zero coupon bond. It's bond without interest. That's all you need to know quickly about that. Yeah, and you can also have a convertible bond, which you should be very comfortable with now, because you even know how to do the valuation in previous syllabus. So convertible bonds are those bonds that have options for conversion into equity. So they are naturally debt, but they carry an option, to convert to equity. So it's left for the buyers, the investors, to decide whether they would rather collect redemption amount, which is at the expiration of the bond, or they will not collect the money, but instead collect shares. And that is conversion to equity. Yeah, very important. Something close to that, which I'm going to mention to you and explain, is when you have bonds with warrants. So, because I know students always confuse convertible bond with bonds with warrants. Please pay attention to this. Yeah. So this is different from convertible bond. Convertible bond is just a single instrument. Yeah, and that single instrument can either be redeemed with cash or as equity. But when you are talking of bonds with warrants, you're practically talking of two instruments. So there are two instruments here. And those two instruments include normal bond, which will be dealt with as a bond and always as bond, plus the warrant, which is separate. Though they are included in the same contract, but it's treated as a separate instrument. Yeah. So this separate warrant is like an option to buy shares at a particular price. So it's left for the buyers, the investors, to decide whether they want to exercise this warrant or not. But whether they decide to exercise the warrant or not, it doesn't change the fact that they still have a bond. And that is why it is different from convertible. Convertible bond is just one instrument that can be converted or not. But when you have bonds with warrants, you have bonds, you now have in addition a warrant, an option to buy shares. So if the price makes sense, say if the exercise price is less than the market price, definitely investor will exercise. But if the exercise price is more than the market price on that date of exercise, then definitely the warrants will just expire and the buyer will not exercise. So please take note of that. Another type of bond you can have is junk bond. Yeah, and junk bond, as you know, is high risk bond. That's why they are called junk bond. It's high risk bond. Yeah, with risk of default. You might not be able to get your money back. However, they give high return. Remember, the higher the risk, the higher the reward. So if you are willing to take this kind of risk, you are promised a very high return. But guess what? They are so risky that you might lose both the return and your capital. So you have to decide. And the opposite to that is what you call the investment grade bond. Investment grade bond. And these are very low risk, very good bonds issued by good government or good companies, stable enterprises. Yeah. So this one definitely has low risk. And if the risk is low, you can expect that the return will also be very low. So that's investment grade bond. Also, you need to know this concept when we talk about senior and the subordinated bonds. Yeah. What senior means is that upon liquidation, if you hold a senior bond, it means that you will receive your principal and interest before other bondholders. So you are senior to them. You will be attended to before other holders. And if you are holding a subordinated bond, it means that you will not be attended to until all other bondholders have been attended to. So this is like the opposite of senior, right? So this guy is lower in the rank. He's a subordinate. It's lower in the rank of settlement. But like you expect, if you're lower in the rank, it means you have high risk. So this risk is high, whereas this guy has a low risk. So good to know what that means. Another type of bond that I'm going to be talking about is the mezzanine, which you definitely have heard about in FM, mezzanine finance. When you talk about mezzanine, you're talking of hybrid instruments of both debts and equity. Yeah. And definitely, this is very risky, as you can see. This type of bond that is already having equity component will be very risky. And that is why they are the lowest ranked debt. In fact, after mezzanine, you go straight to equity. Equity is definitely riskier than debt. So this mezzanine finance is just like in the middle. So very risky, and is an hybrid instrument of debt and equity component. Also good to understand the concept of Eurobonds. I've heard students saying Eurobonds are bonds that are issued in Europe. Please, that is not correct. It doesn't have anything to do with Europe. The Eurobond is just signifying foreign. So in case, what we're saying is that these are bonds that are not issued in the local currency. So that's a simple way to put it. So they are not issued in the local currency. So take for instance, if you are talking of euro-dollar bond, euro-dollar bond. This is a dollar bond, so which means you cannot issue this in the US. So it means that euro-dollar bond will be bond that is issued outside the US. It cannot be issued in the US. If you have Euro Pound bond, it cannot be issued in the UK. Euro Yen bond cannot be issued in Japan, right? So the word euro just means it's foreign. So the currency of the bond will always come, and that currency will determine where the bond cannot be issued, not where it is issued. Please take note. Quickly, let's talk about SME finance. Yeah, because usually they struggle to get debt finance. So it's a common point of reference. Remember your exams, even if there are big chunk of questions and big chunk of marks allotted, there will still be small little questions that will have 2 marks, 1 mark, 3 marks, which you need to put together to pass your exam. So you can be asked, why do you think SME will struggle to get financing? Yeah, and the major reason is because of their high risk profile. Because they are small companies, definitely they are considered to be high risk. And if they are high risk, the cost of debt will be very high. So they might not even be able to afford it. Yeah, so affordability might be a problem. Likewise, because they are a small company, to get debt, you most likely need collateral. So they might struggle to get security, or what you call the collateral. And that might make debt finance companies not to be able to provide them with those money. Likewise, they are just coming up. They don't have track record. So credibility might be a problem. They might struggle with credibility. Yeah, and that might also be attributed to the fact that their financial statement is not transparent, because most of them are private. They don't even get audited by Big Four auditors, and debt providers might not be comfortable with that. Yeah, so this struggle creates a problem for them, and that problem is what you call as funding gap. And what is funding gap? Funding gap is a situation whereby the amount required, the money that they want, is less than the amount provided or available. So they have a gap. They are not able to get the amount that they need. Please take note, this is different from maturity gap. Don't confuse funding gap with maturity gap. In maturity gap, what you are saying is that there is a mismatch. There's a mismatch of assets and liability maturity. So take for instance, you have a liability that needs to be paid in 10 years' time, whereas the asset that you have is account receivable. There is a mismatch because the money would have come, whereas the liability is still in the future. So either you use the money in a different way before you even due for payment, or you're not able to use the money properly for a long-term investment and make more money since you don't have obligation immediately. Or you probably even have OD as a liability and your asset is in a real estate long-term. Then that will be a problem because your OD will be due immediately or very soon, whereas you won't find cash to be able to pay because your cash is tied into a long-term investment. So that's a maturity gap, which is also common with SMEs. Yeah, it's another problem SMEs have. So please take note the difference between the funding gap and maturity gap. But when you have a problem whereby these SMEs are not able to get money, they struggle, what are the solutions? Where do they get money from? So you expect them to get money from business angels, which are individuals. Please take note, these are individuals that provide monies to organizations, with the intention that the organization gets better and they're able to make return from that money that has been provided. Business agents are different from venture capital, which is another source of money for small companies. especially startups. So venture capitals are institutions. That is how they are majorly different from business angels. These are institutions. They are companies. Yeah, they always look for promising companies, small companies that are struggling but with a lot of prospects. That if they acquire those small companies, they turn it around, then they can sell it once it start getting better. Also, government can support SMEs. Yeah, government support, very important. Yes. Bank loans as well might come handy. Yeah, even overdraft. Yes, and also some of them also go for leasing. Yeah, yeah. Remember, when you're talking of leasing, you can have an operating lease, you can have a finance lease. Operating lease is when you don't have rights to buy at the end of the term of the lease, which means significant risk and reward still lie with the owner of the asset. Whereas when you have a finance lease, the significant risk and reward sits with the lessee, which is the person using the asset. And most likely, the lessee will have the option to buy the asset at the end of the term of the lease. So depending on what the company wants, the amount of cash flows they have, we will determine which approach they want to use, whether it's operating lease or financing lease. Yeah, very important. But generally speaking, should a company finance with debt or with equity? Debt or equity? Which one should a company finance with? We've looked at debt, we've looked at equity. There are various factors that a company will always consider, which you need to know. The first one is the tax benefit, might be a factor. If you consider the tax benefit, definitely a company will go for debt because the interest on debt is tax deductible. Unfortunately for equity, dividend is paid out of profit after tax, and even the dividend is even taxed again. So if you're tax conscious and sensitive, you're probably going to be interested in debt. Yeah, likewise, cost of capital is a big problem and big factor. Yeah, generally debt is cheaper, so if you're also looking at cost, you might be looking for debt. Also, if you are considering dilution effect, you don't want dilution, also this will make you to go for debt, because with debt the owners remains the owners, there is no dilution. Yeah, likewise, obligation to repay, or maybe you call it risk. Yeah, and this you need to understand depending on the perspective you are looking at. So if you're looking at company that is looking for fund, yeah, I want to look for fund, which means I'm not asking should I sell shares or should I just go and borrow. If I'm looking for less risky, definitely equity is less risky for the company because there's no obligation to pay back equity. Whereas if you go and do your financing with debt, for the company, it's a pressure, it's high risk for them. Gearing, that's what you're talking about here. This will increase your gearing if you take that. So companies will rather take equity if they are risk adverse, because for equity, even if they fold up tomorrow, they don't have any obligation to pay any shareholders. Whereas if they have used debt, they must pay and sell their asset. All right. Unfortunately, this is different for investor. For investor, they will prefer debt because for them, debt is less risky because they know that their money is guaranteed. So it's the opposite depending on the perspective that you're looking at it from. So please, I need you to understand that so you're able to explain. Like I said, in this paper, application of knowledge is what you need. You don't have to memorize anything. Yeah. Another factor you can think about is the transaction cost. Yeah. So when you want to collect debt or you want to issue equity, there are transaction costs that are involved. And usually it is more when you are issuing equity than when you are trying to get debt. Likewise, covenants. Yeah, for debt, most times covenants are attached to it. Either you have a minimum positive cash you must have, or you have a minimum profit you must make. You're just going to have some covenants, some restrictions. Yeah, and if those restrictions are too much, you might not be able to get money from debt. You might decide to go for equity. And likewise, availability. Yeah, and you can remember when we talk about pecking order. Yeah, right. Retained earnings are usually available. Then you can go to bank loans or go issue bonds, or the most difficult ones to issue is the shares. Right. So all of that might influence your decision as to whether you want to issue debt or you want to issue equity as a form of financing. That is a quick one on debts, and the final one on those key policy decision is the dividend policy. Yeah, it was a quick refresher on dividend policy. And for dividend policy, remember, you have invested, you've made money. What you are asking now is, how much should we share? Yeah, and when can we share this profit? That's what you are saying. And there are two school of thought to this. The first one is the residual policy, which you can use. And when you are talking of residual policy, you are saying that when you make this profit, you must first of all invest. Then after, so you invest first, then after, share the remnant. That's why it's called residual. Share the remnant. Yeah, which is the residual. The residue. The remaining amount. After you have done all the available good investment. That is residual. So that is what you have to do if you are using residual policy. Whereas there's M&M that says there's also a relevance policy by M&M. And what this one is saying is that shareholders can make money from share capital gains. So that is by selling their shares and making profit, or from dividend. And for shareholders, they don't care where the money is coming from. They just want to make money. That's why it's called irrelevance. That's whether you share dividend or not, it's not relevant. If you share dividend, we are happy. If you don't share dividend, we believe that you are going to invest the money. And when you invest the money, you're even going to make more profit. So the share price will go up and we can sell our shares and make some capital gains. That is just money. So money is money. That's what relevance theory is talking about. Wherever it's coming from does not matter. Once it's legitimate money, we're fine. So this decide when we will pay. Right? But how much, if we decide want to pay, how much can we pay? And when you're talking of how much, you can have a constant payout, which means a company has a policy that says whatever we make that we want to distribute, it's going to be 30%. Yeah, of profit after tax. A company can have that policy. So which means when they make $100, they will share 30. When they make $200, they will share 60. So it's about 30% of profit after tax. That is constant payout. So they have a constant rate that they used to pay out. Or they can just have a stable dividend policy. So which ones they are just saying that let's stay stable. Yeah, because we don't know. Some days might be good, some years might be bad. So if they say we stay stable, you discover that there's going to be a slow growth of dividend. So they are practically just paying dividend around the same amount. $1 per share, $1.1 per share, 1.102 per share, like that every year. So there's not so much increase, but at the same time, they are consistent with payment of dividend. And you can even have a company that will say, I want to do a constant dividend, which is difficult because you don't know how much you will make or which year you will not make profit. So constant dividend is saying the same amount. That's what it's saying. $1 every year. This is very rare. This is the very common approach that most companies use. So that's the information you need to grab about the dividend policy. In next video, I'll be looking at risk management.